Hello, everyone. Thank you for making the choice to invest in yourself and your practice by joining today's financial planning session. Today is all about helping your clients retire with confidence. We are going to address the client question: is it better to take the commuted value of my pension? My name is Alex Mercer, and I will be your host today. I'm joined by my colleague Steve Arnott, Snap's financial planning project lead, who will provide today's demonstration and run the Q&A. If you were just joining, don't worry, we are just getting started now. Thank you so much, everybody, for being here on time today. So before we get started, I'd just like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your question tab? You should see it in your control panel. Just click the arrow beside the word question and a window will pop up where you can type and hit send. This is exactly how you'll send any questions you have throughout the session. Oh, wonderful. Thank you so much, Paul, Miles, Jeff, Sean, Cassandra. So glad to know you can see Steve and I, you can hear me, and you can see my screen. So we have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. So some of you here today are already using Snap projections for your financial planning needs, or perhaps you've been to some of our webinars before. For those of you who aren't already familiar with Snap, Snap is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you want to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third-party software review site, you will find advisors saying things like none of their clients retire without a Snap projection, and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. And we are thrilled to share that Snap Projections financial planning software is now fully available in French. We are also now providing customer support and product demos with a French language team member. So if you'd like to do a one-on-one demo in French, you can now book that right from the main website. So before we get into the case study, let's think about the benefits of being able to easily compare what-if scenarios for your clients, because that's exactly what we're focused on here today. Your clients have important financial questions that require personalized answers and recommendations. For example, should they purchase corporately owned life insurance? How can they reduce OAS clawback? Can they afford to retire earlier? And the question we're going to address today, is it better to take monthly payments for a defined benefit pension plan or take the commuted value now? As always, the only correct answer is it depends. As the advisor, you can provide truly personalized advice that leads to optimal client outcomes by building multiple what-if scenarios to compare options. So what you're going to see here in just a few minutes when I hand this over to Steve is how we can quickly build multiple plans, compare them, and then ultimately use this functionality to highlight the net difference between where we started and where we're going. This is how you, as the advisor, can not only improve your client's outcome, but easily demonstrate the value of working together. This is a highly flexible module that allows you to pick which metrics you wish to compare and highlight. It allows you to change the timeline of your comparisons, and you can visually compare metrics with additional charts. Everything we are doing here is with the underlying goal of optimizing the client's outcome. So let's get to today's case study. From scratch, we are going to build a projection with a defined benefit pension plan. We'll create a second scenario that models taking the commuted value instead to compare the scenarios across a range of important and customizable metrics. We'll also evaluate the exposure each projection has to market volatility to help create the most informed comparison possible. Once the client is confident with an approach, we'll provide a digestible and actionable report to help them move forward. So I'll get Steve to take over now and log into Snap.
Terrific. Thanks so much, Alex. And thanks again, everyone, for joining us today. Snap Projections is a web-based platform, which means you can access your account from any Chrome browser on any computer without a need for a download. You'll go to snapprojections.com, and then in the top right corner, you'll have the ability to log in using your username, password, and the option for a multi-factor authentication. I've entered that all during today's session, so I'll click login and go directly into the software. I'm taken initially to my clients page where I can access any of the previous projections I've created, or I can get started on a new client file by clicking Add New Client. As Alex mentioned, we're going to be creating a series of projections today for our client, Lorene Alvarado, and that is going to be used to address her questions related to retirement and her defined benefit pension plan. So Lorene is currently 62 years old. She was born in 1963, and she currently lives in Ontario. In the top left corner of the software, you'll see that there are three main sections to the tool. The first is the scenario setup. This is where we proceed through the initial plan data, such as the client information, general plan settings, expenses, incomes, assets, and so forth. Once we're finished entering in the scenario setup, we'll then proceed to the planning pages where all of that information comes together to show us our client's life on one page. From here, we can edit any value, review the information, and once we're comfortable with the projection, we can then proceed to the client report, where we can select the charts, tables, and commentary to include in a final client-facing document. For now, we'll continue on with the scenario setup. I'll click Next at the bottom of the page, and we'll go to the general plan settings. Lorene is hoping to retire at the start of the year that she turns 63, and we're going to run the projection until the year that she turns 100. We're going to use the FB Canada guideline assumptions for inflation rates, and then we've taken those same FB Canada guideline assumptions and we've reduced the gross return assumptions provided by expected management fees to arrive at a net return assumption for each asset class. I'll click Next and go to the expenses page. There's lots of flexibility for how to input expenses in Snap. If you have detailed budget goals or information about your client's spending, you can enter that information here, or you can always leave this page blank and then proceed to the planning pages where Snap will be able to help you to calculate what a realistic expense goal would be. In this case, we do have a target spending in mind. We're looking for $60,000 per year once she retires, net of taxes and adjusted for inflation over time. She's also looking for additional travel of $10,000 per year on top of the $60,000, and that would start at age 63 and run until age 74. And we'll highlight that goal so that it will be called out within the charts. Now that we've entered in the expenses, I'll click Next to go to the incomes page. Lorene is currently earning $120,000 a year, and she has historically been receiving cost of living adjustments, so we'll index that income with the general inflation rate. It's being input as employment income, so Snap will automatically deduct CPP and EI. It will also tax it appropriately and earn and track RSP room going forward. It's going to start immediately and then run until the end of the year in which she turns 62. We can add additional income as needed, such as a rental property. And we can also enter in defined benefit pension plans, which we'll be doing in this case with a start age of 63. Her benefit before age 65, including the bridge, is $42,000 per year, and she has a cost of living adjustment guarantee of 70% of inflation. So we're going to input an indexing rate of 1.5%. Then once she turns 65 and the bridge benefit ends, she's expecting $35,000 per year, also indexed at that 70% guaranteed rate. Clicking next, we can go to the assets page where we can enter in all of her existing savings and investments. You'll see that Snap has added a default non-registered account already. This is to serve as a place where you can allocate future surplus if they don't already have a non-registered account. In this case, she does have a savings account that we'll repurpose this into with $25,000, and that's currently 100% invested in cash. She also has a tax-free savings account with $140,000, and that's invested as 40% fixed income, 60% equity. And you'll see Snap has automatically pre-populated the rate of return for each account with our general plan settings. Now we can adjust these on an account by account basis as needed. So if you expect a higher or lower rate of return for a particular account, you can always make that adjustment here. She also has an RRSP with $320,000, and that's similarly invested as 40% fixed income and 60% equity. Now that we've entered her 3 investment accounts, you'll see across the top of the table that there are tabs for each of the registered account types. If I click on any of those tabs, I can customize additional settings related to that account type. So here we have the assumed contribution room at the start of the projection. If the client has additional carry forward room, you can input that here, and that's just going to ensure that the plan is more accurate and reflects your client's unique circumstances. And this is a common theme throughout Snap, where you can get started with a quick, simple projection that uses conservative base assumptions, or you can come into these settings pages as needed and refine the assumptions to reflect your client's unique case. Similar for the RSP RIF tab, we can adjust the contribution room to reflect her carry forward available of $120,000. Going back to assets, we can scroll down to the real assets section and input her home, which has a current value of $750,000 and an original cost of $400,000. That defaults to appreciate at the rate of inflation, which you can adjust as needed. We do have the ability to model a future purchase age or sale age. So if your client is saving up for their first home, looking to downsize, buy a cottage or investment property, you can model any of those transactions from this page. You can also then indicate if any of those transactions would be capital gains applicable. Clicking next, we'll go to the debts page. Now, in Lorraine's case, she's actually paid off her mortgage and she has no other outstanding debts, so we can leave this blank, but this is where we would add the mortgage if applicable to the plan. And then clicking next again, we can go to the government benefits page. In our base case, we're going to assume that she starts CPP at age 65. So you can see here, you can control her start age, and then you can either enter in a dollar value for her expected pension or a percentage of maximum. So if you have a Service Canada statement or they're already receiving their CPP, you can put in the dollar value here. If you don't have that information available, you can estimate how much they'll receive based off of their employment history. Because we don't have all of that information available in SNAP, we assume the national average benefit, which is about 57% of the maximum. In this case, given Lorraine's history and salary level, we're going to assume that she'll receive 85% of the maximum once she starts at 65. For old age security, we'll also start at 65 and we'll assume the full benefit of 100%. And just like that, in about 7 minutes, we've been able to input the scenario setup data for Lorraine's case. You'll see that we do have additional pages available on the left. We have insurance inputs, we can add an RESP, customize additional settings as needed, and then input corporations. But for Lorraine's case, we're all set. We're ready to click on planning pages and see how everything that we've entered so far can come together to show us her life on one page. Now, this page can seem overwhelming the first time that you see it, but once you know what you're looking at, it's an incredibly intuitive and very powerful section of the software. On the left, we have the year and our client's age. Then we have the calculated discretionary cash flow that Lorraine has available for spending or savings purposes. This 86,000 figure is being calculated by taking the employment income of 120,000, subtracting off the CPP and EI, subtracting off total taxes, and then subtracting off any other contributions, debt, or other cash flow needs within the plan. There's other great information on this page, such as the taxable income level, marginal and effective tax rates, account balances, rate of return, contributions and withdrawals, and then we see information about the home, net worth, and estate. Any of the blue or purple values that you see throughout the page are fully customizable. So if I click, for instance, on the contribution for the TFSA, I can input the maximum contribution for the year. Once I've entered that contribution, you'll see that our Run Scenario button in the top right has turned orange from green. This is just allowing you to make multiple changes on the planning page prior to recalculating and adjusting all of the numbers. So if I also want to enter in her $20,000 RSP, I can do that first. And then once I'm done making any changes, I'll just click Run Scenario, and that's going to recalculate everything. With those contributions now reflected, you'll see that Snap has recalculated the available cash flow down to 66,000, which is how much she has left over for spending purposes. That would continue for the period while she's working, and then once she retires at age 63, we have our automatic cash flow management turned on, our target spending of 60,000, that's net of tax, and then it's being adjusted over time for inflation. We also have our additional travel goal of 10,000 a year, adjusted for inflation. And then we have our sources of cash flow. We have pension income for the next 2 years, and then the bridge benefit stops. We have CPP and OAS starting at 65. And then with the financial assets, we can see that Snap is automatically withdrawing on a tax efficient basis from those assets in order to supplement our pension income and provide our needed spending. So that process continues all the way down throughout retirement. And then we can see whether or not the financial assets are expected to run out before the end of the plan. So as of 2055, when Lorene is 92, we can see that she would reach a balance of 0 in all 3 accounts. And then on the left, we can see the total expected shortfall on an annual basis. So her target spending is 114,000 at age 93, and she's short of that by about 24,000. We can then see the cumulative shortfall, which is about 255,000 by age 100. And we can compare that to the equity expected to be available in her home. So still well within a reasonable equity. So she could either use a reverse mortgage, line of credit, downsize in order to fund that final period of retirement if needed. We can also review this plan in the form of charts. So we have the cash outflow, which includes the target spending of 60,000 a year, the additional travel, taxes payable, contributions to investments. And then we can see with the total inflow in the last roughly decade, we start to be about 20 to 30% short of our total spending need. In the cash inflow, we can see where our money is coming from each year. And again, in this last period of the plan, we can see that we run out of financial assets and we just have income from our guaranteed sources. And then with our net worth chart, we can see how much would be available across assets and debts. And all of these charts are fully interactive. So if I remove something from the legend, I can zoom in on different views. So this would be liquid net worth and then the expected shortfall at the end of the plan. So that's our first scenario that we wanted to create in order to start answering Lorene's questions. I'll go to her list of 4 questions that she came to us with. The first one is, am I on track for retirement if I receive my monthly pension payments? So in this case, what we've been able to show is that at an annual spending of 60,000 net of tax adjusted for inflation, she's expected to run out of financial assets at age 92, and then she would either need to borrow against her home for the last 8 years, or she would need to reduce her spending by about 30%. The next question she has is whether taking the commuted value would improve her retirement readiness at all. So we'll go back into Snap. I'm going to first update the title of our first scenario. This can be helpful just to keep things organized as you create multiple scenarios in the software. You'll always know what a plan is reflecting and what settings were applied to that projection. So this is 60K retirement spending with the defined benefit pension plan. In order to create a second scenario with a commuted value, I'll first need to click on the menu button and then click Copy Scenario. When I create a copy, you'll see the name is updated with copy in brackets at the end. And the first thing I always recommend is just to update the title to what you plan to do in that scenario. So this will be Scenario 2, 60,000 retirement spending with commuted value. And now we'll need to go through a few steps in order to remove the pension income and add in the equivalent commuted information. So we'll go to Scenario Setup and then Incomes. We'll go to the defined benefit pension section and we're going to just delete that input. And we're going to replace it with the two components that would make up the commuted value. One is a lump sum taxable income and the other would be a locked in account for future withdrawals. So we'll click Add Income. We'll call this the commuted value, taxable portion. And that would be for $360,000. We'll enter that as other income taxable yes, and that'll be just in the year that she turns 63. So from and to both as 63, and that's just going to create a one-time lump sum income. From there, what we'll do is proceed to the assets page, where we can then add in a new account. So we'll call this Lira. That'll be for 440,000. And we'll expect that that'll be similarly invested into a balanced portfolio. However, because we won't receive this money until next year, we're going to start the return assumption at 0%. And then on the planning page, in any future year of the projection, we can adjust the expected return from that point forward. So we'll turn on the return assumption as of 2026 in the plan. So now that we've made those two adjustments, we can go back to the planning page and review the outcome for the commuted value scenario. So under the incomes and government benefits section, you'll see we no longer have the pension income. It's been replaced instead by a commuted value of 360,000. We're using up all of the available RSP contribution room to try and offset as much of that income as possible. The remaining is being taxed of about 91,000 in the year, and then the net proceeds are being deposited into the TFSA and savings account. We also have the Lira, which has the starting balance, and then we start withdrawing as of retirement, and we'll also turn on the rate of return assumption from that point forward. So we go from 0 in the first year to 3.8. And you can do that at any time and as many times as you want for an account if you want to show de-risking as a client approaches retirement, for instance. Once they have a lump sum in the savings, they might also choose to reallocate some of this. Maybe they would do 40% cash, 40% fixed income, and 20% equity. So we'll see an updated return for that account going forward. Now that we've made those changes, we'll click on the run scenario to get updated numbers. Because we have less guaranteed income in the plan, you'll see that SNAP is withdrawing more money on an annual basis from the financial assets in order to provide the bulk of her spending. As we continue down throughout retirement, we can see that a similar shortfall would start to occur. In this plan, it's as of age 91. But because they don't have that defined benefit pension plan, the annual shortfalls are much larger. This is closer to 50 or 60% of her spending need is no longer available. And the total shortfall by the end of the plan is about 800,000, which is roughly half of the value of the home at the end of the projection. So it's starting to get close to the maximum that would be available for something like a reverse mortgage. Now that we've created these two scenarios, we want to be able to compare the outcomes across a wide range of considerations. To do that, we have a dedicated scenario comparison tool that I can access by going to the menu option and then clicking Compare Scenario. I'll select the two plans that we've created so far and then click Compare Selected Scenarios. We have a wide range of customizable metrics, so you can choose whether to include any of these values in your charts. The first one is the goal progress. So this is how much of the client's target retirement spending is funded through liquid financial assets within the plan. So in this case, we have 95% of the spending goal is covered. That shortfall of 5% was the 200,000 shortfall that we saw at the end. Once we switched to the commuted value, we see that that funded status drops to about 84%. In both cases, the total lifetime expenses are the same, so we're comparing apples to apples, which is important to remember. And what we can see is there's a total shortfall of 255,000 with the pension versus 800,000 with the commuted value, which ultimately leaves a $1.4 million final net estate versus 880,000. The important thing to consider is that right now we're comparing as of age 100. So if a client lives to age 100, naturally their pension scenario is going to look best because they've been able to receive that guaranteed income for a much longer period. We can, if we want, compare these scenarios at different points in time. So we could change to age 90 or 80 if we wanted to within this table. Or we can go into the trends section, which shows us the metric each and every year of the plan to make it easy to compare over time and see how plans change depending on how long the client lives. So here it becomes a much different view where yes, scenario one is preferred if they live to age 100, but we can see that if they were to pass anytime before roughly age 92, they would be better off having taken the commuted value. So this is where it can be very helpful to understand what your client's priorities are, whether they have longevity risks or concerns, whether they have specific estate goals, and we can see how the outcome of their projection differs depending on which strategy they take and how long they live. So now that we've created the two scenarios, we'll go back to her list of questions and address the second one. So does taking the commuted value improve her retirement readiness? It doesn't improve her retirement cash flow because, as we've seen, her shortfall is expected to occur at roughly the same age, and then it would be a more significant shortfall from that point forward. However, the commuted value does improve her net estate considerations if she were to pass away before age 91. The next question she has is how much she can spend in retirement in order to try and minimize the risk of running out of money. So we'll go back into the software and we'll start first with the defined benefit pension plan case. And we have some dedicated calculators in SNAP underneath the recommendations toolkit. So you'll click recommendations, we can see that underfunded status, and then we have the ability to see what changes to the plan would allow us to eliminate that shortfall. So could she save more before retiring, retire later, or what we're going to check now is the sustainable spending. How much could she spend throughout retirement to avoid the projected shortfall? And in this case, she would need to reduce her 60K target down to $57,800 a year. I'm going to click the copy scenario button in the bottom left and then click apply and run in order to create a new scenario with that spending goal in place. So now you'll see the title has added sustainable spending at the end. And as I scroll all the way to the bottom, we can see that there's no longer any shortfall. We use up our financial assets as of the final year. I'll do the same activity for the second scenario. So using the commuted value, we'll go into recommendations, see the current underfunded status, calculate the sustainable spending, and then before clicking apply and run, I'll click copy, and that'll create a second scenario where I would need to reduce the spending to about $54,000 per year. So now we have 4 scenarios, 2 with our target retirement spending and 2 with a reduced spending level to try and avoid any projected shortfall. So we can include all 4 in our scenario comparison and then take a look at the outcomes. So here we had shortfalls occurring, whereas scenarios with the sustainable spending have targeted that fully funded status, and they've done that by reducing the level of spending. So rather than spending 3.7 million throughout her life, she would spend 3.5 or 3.3 depending on which scenario she chooses. We can also review the trends, which again shows how much she's expected to have, and we can see both cases that are sustainable spending and with the home as the only value as of the final year. And again, all of these charts are fully interactive, so we can add and remove as needed. And then we can, of course, include other metrics in our analysis. So we could look at the base expenses, which is how much they're spending each year. And here we can see that in order to create sustainable outcomes, we've dropped the spending to 58 and then to 54,000. So lots of great resources that you can use in your discussions with clients. You can print any of these charts and tables and then save them as a PDF. Similarly, you can generate the summary tables, and you can easily change which scenarios to include in your analysis in order to get different views. Going back to the list of questions, she wanted to know how much she could spend, and we've determined that it would be about 58,000 with the defined benefit pension plan and 54,000 with the commuted value. The final question she has for us today is related to the future market performance and what would happen if things go worse than expected from a rate of return outcome. So we'll go back into the scenario. We're going to start with the defined benefit pension plan scenario. And right now, as you'll recall, we're simply applying the static annual rates of return throughout the projection. So we have our expected average returns, and we're just applying that on a consistent basis throughout the plan. We have a dedicated add-on feature available called stress testing, where we can replace those static annual returns with randomized or historical returns in order to introduce volatility and potentially to introduce lower than expected return assumptions to the plan. So in this case, I'm going to go to stress testing, click randomized scenario, and I'm going to have access to a wide range of potential future outcomes. So we create 100 different potential sequences of returns, and we order them from worst to best case scenario. Right now, we're looking at an average outcome. I'm going to select the 20th worst case, which means that 80% of the time, Lorene should fare better than this, and 20% she would fare worse. So we're going to select that sequence, which has this result for equity, inflation, cash, and fixed income, and we'll click apply and run and see the results of the projection. So now in the rate column, we can see that the return is varying on a year-to-year basis. We have some years that are negative, some that are positive. And as we scroll down in the plan, we can see that due to the lower than expected returns and due to the volatility of returns, she's expected to run out of money starting at age 83. And by the end of the plan, she would have a shortfall of about 600,000. So we can once again click on recommendations and then calculate a new sustainable spending given those lower return assumptions. And we see that she'd need to reduce her spending to roughly 53,000 per year. So this can help us to understand how exposed a projection is to market return assumptions. Because a lot of her future income is guaranteed through the pension and government benefits, this plan is less exposed to potential market downturns. Now, on the reverse of that, it's also less exposed to potential upside. So she would have less upside and less downside. But it's an important consideration if a primary concern is longevity and making sure that she doesn't outlive her money. So I'm going to update the title of this scenario in order to include the randomized stress tested returns. So we have scenario 3. Then I'm going to do the same thing with our sustainable spending for the commuted value. So we'll go into stress testing, click randomized scenario, pick the 20th worst case, and then apply those returns to the projection. Again, we see some positive, some negative years. And in this case, we'd run out at age 94 with a total shortfall of 544,000. So going back to recommendations, we would click calculate. And in this case, you'd have about 49,000 a year of spending capability. So it just shows a wide range of tools that are available in Snap to help you have different conversations to allow clients to make informed and confident decisions as they navigate these life-changing situations. Now that we've selected a particular plan that we want to recommend to our client, we can go back into whichever scenario they're most comfortable with. In this case, she wants to go ahead with the defined benefit pension plan. So we would go into that scenario, and now we're ready for the final stage of the plan creation process, which is to use the client report in order to create a customized one or multi-page report to help her summarize this information and have a reference point for future discussion and to refer back to over time. Before we create the report, I just want to kind of go back and once again confirm. So what happens if markets perform worse than expected? We've shown that if markets are poor, then she'd have less spending capacity in the scenario with the commuted value, but it also limits her upside potential. In order to create the client report, we would start with the report builder. This is where you can select what charts, tables, and commentary you want to include. You'll see we have access to things like the cover page, a note to reader, our snapshots section, which is a bunch of summary pages that can be included on a single page, and then a wide range of other supporting documents. Now, if you wanted to create a 1 or 2 page report, you can quickly do that by clicking on snapshots only. And that's going to ignore all of the larger detailed pages and just focus on these 10 summary sections. So now that I've filtered the report to just be the snapshot, I'll go to Report Editor, where we can review each of the pages individually, make any adjustments, and then review the final report. So if I click on Goal Summary, you'll see that Snap is already providing automated language within the report. So we have the retirement age and year, we have the pre-retirement spending assumption, the post-retirement spending, and all of these are referencing variables within the software. So these aren't static values that you need to update if you make changes to the plan. If you adjust the retirement age or the spending goal, that will automatically be reflected within the report without any changes required. And you can also make reference to any of those templates by entering in your own bullets. So we'll say additional travel, starting at, and then we can say retirement age, retirement year, and that way it'll be dynamic for any future changes. We can also remove bullets if we want. So if we wanted to get rid of any information or replace it with static text, we can of course make those adjustments. We have similar access to making changes for the assumption summary. We have the goal status, that 95% funded that we saw originally. And then we have some options available to address the shortfall. So we could spend 2,000 less, or we could use equity from the home. So we can add custom text as needed. We have information about her contributions for the next year and then where her withdrawals will start coming from. We have her current net worth broken out by categories, a summary of her expenses with the shortfall, how much she'll have available across asset classes, and then the shortfall again. Retirement income, so where her money is coming from each year. Her final estate, and then a customizable recommendation summary where we can input information that's needed to supplement the report. So here we're just giving her congratulations on her progress so far, an explanation about what we expect to be best for her. So taking the monthly pension will diversify her income sources and protect against longevity risk. And then in our next meeting, we can discuss government benefit timing, withdrawal strategies, and how to supplement her pension income in retirement. So now we can click Report Preview and review the information, make sure that we're comfortable with how everything is being reflected. And then we'd be able to click Generate PDF and download the file for our meeting and discussions. Now, we have had to move quite quickly through the software today to show you a range of capabilities that you would have available. If we go back to the planning pages, you'll see that we have other functionality available, things like adding corporations, we have needs analysis to see if enough insurance is in place. And the second that you sign up for your free trial, you will have access to both our help site. So clicking on help in the top right, you can then go to Help Center. From here, you can access any of our previous webinars that we've done on particular topics. So this ranges from anything about how to use specific features as effectively as possible to tips and tricks when planning for clients in different stages of their lives. You can also search for key terms like inheritance, and that's going to bring up articles related to how to enter those types of transactions in the software. And if you have any questions, you can give us a call directly, send us an email, and we can schedule time to address any of your specific plans that you're working on and make sure that you're confident moving forward in the software. With that, I'm going to pass it back over to Alex to take us through a few next steps, and then we're going to open it up for your questions.
Wonderful, Steve. Thank you so much. So as Steve just said, sorry, we have covered a lot this hour, but we are here to address any questions you have in just a moment. So you saw at the beginning that we do have a special offer for those of you here with us today. We are going to give a gift to every single advisor who signs up for a free trial of the planning software today. Each one of you who starts before midnight Eastern time today will receive an extended 1-hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template, just as you saw Steve do moments ago. The snapshot is very flexible, but it's most often being used by advisors in 3 different ways. First, it can be used as a standalone client deliverable that essentially replaces the longer client report. Next, it's being used as a 1 to 2 page quarterly or annual review, and it can be used as the executive summary to the full comprehensive report. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one-on-one to create your template so you can instantly pull a 1 or 2 page report from your projections. On our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. The Advisor Business Plan is the plan you want for the corporate module. If anybody would like to see that, let me know in the question box and we will try to cover that in the Q&A. You can upgrade and downgrade anytime, so don't worry too much about which one you select today. The stress testing add-on that you saw Steve use to help educate our client on market volatility is free during your 14-day trial, so I'd encourage you to enable that right away. This is our one and only add-on. All other features are included within the plans. I've dropped a link in the chat. So if you click the arrow beside the word chat, you can open up that box, and that is the special link that you can use today to make sure you get to take advantage of this special offer. And for those of you here today who are already using Snap, thank you so much for being here today. We really appreciate you being part of the Snap community. A reminder that you can be earning free months of SNAP when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of SNAP, and the referring advisor gets an entire free month of service when the person they sent our way becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. So when you pair being on annual billing, sending a few referrals, it's really, really great for your own bottom line. There's no limit on how many times you can do this. And we've created a new referrals page that you can access from within your Snap account that makes it easy to take advantage of the Snap referral program. So with that, we can now move on to our Q&A. So any questions you have, send them in through that question tab now, and we will hop into it. So one question I have here, Steve, is about inflation. So can you explain to us what's built into the software as a default and why, and then explain how advisors can customize this, and also potentially look at having, maybe different inflation rates during different periods of time?
Yeah, absolutely. So if we go back into scenario setup and then our general plan settings page, we have the ability to set the general inflation rate for the plan. So this is the rate at which the client's base expenses are assumed to increase. It's also the rate applied to things like tax brackets and tax credits that are indexed to inflation over time. This 2.1% rate is taken from the FP Canada guideline assumptions. So every April, the FP Canada guidelines are published and they provide reference points for use in long-term financial projections. So as an example, if we go to the inflation rate, they provide a long-term rate assumption of 2.1%. So that's what's pre-populated into SNAP. You can, of course, change that if necessary. So if you wanted to run one scenario at 2.1%, we could then copy the scenario, change our assumption as a stress test. So we would do scenario 5 with 3% inflation. And then we could go into the general page, increase that rate, and then we would go to planning pages. Now our expenses and other values linked to inflation would increase at a faster rate. And we can see as a result, we would have a shortfall of about $1 million at the end of the plan. So it can be powerful to show how impactful inflation assumptions are to the client's outcomes. So that's how we can change it in the projection. And then when we ran the randomized scenario, so if we go back there, we can see that SNAP is automatically actually fluctuating the inflation rate similar to what we would see on an annual basis. So it's looking at historical volatility of inflation and applying that to your expected average going forward. So those are some of the ways that we can interact with the inflation assumptions and have discussions about inflation with our clients.
Perfect, thank you. Next question, can you show us the corporate module?
Absolutely. So right now we've created a personal projection for Lorene. Some clients will have corporations. It could be an operating business, a holding company. It could be both. We have a lot of corporate functionality to be able to help you to plan for those client situations. So you would click Add Corporation, and then we would input things like the company name, so company ABC. We would have the province of incorporation, whether they have small business deduction eligibility, whether they have any notional account balances to start the plan. so things like RDTOH, capital dividends, general rate income pool. You can leave all of these values zero. It's going to create a more conservative projection without these tax advantages included. Or if the client or their accountant has the information available, they can provide that to you for input into the software. And then Snap will take care of calculating everything going forward. So it's just the first year values that you would need to consider inputting. There's also customizable settings related to ownership, disposition, timing, and tax assumptions. So quite a bit of flexibility in terms of what type of corporation you want to model. We do have support materials, so webinars, articles, and our support team can help with questions related to modeling corporations if you ever have them. Once you've set up the base corporate settings, you would then have the ability to enter in financial and real assets, debts, insurance, and customize other settings. So as an example, I'll just enter in some investments. So they have 500,000 already. And that's invested as 40% fixed income, 60% equity. On the planning page, we then have the ability to model operating activities. So this would be the operating business with the small business deduction and the general corporate rates applied to the operating income. And then on the right, we have the holding company with the ability to model passive investment income at the full tax rate, and then to show the growth and then eventual use of those balances in order to distribute non-eligible, eligible, or capital dividends in retirement. So as a quick example, if she's earning 500,000 in her corp, perhaps paying herself $100,000 salary, $100,000 of other expenses, that 300,000 of operating business income would be taxed at the small business rate. The net proceeds would be deposited into the investment account. And then in retirement, we could pay, for instance, 50,000 a year of non-eligible dividends from her investment balance until that's fully depleted. So that's how we can include a corporation within the projection. And then all of the information that we've entered here, like the dividends, the incomes, that would be reflected and included in the cash flow for the personal side of the plan. So we can see here with the corporation, the value, the salaries, and the dividends being paid out. So it's a fully integrated solution that allows you to include those corporate considerations.
Perfect, thank you. And that's a great segue to the next question. Perhaps you can answer this both corporately speaking and privately speaking. If the client owned several homes and gets rental income, are you able to accommodate that?
Absolutely, yes. So the two inputs that we would do in that case is on the scenario setup assets, we would have the rental property included, and that might have a value of 700,000, cost of 500,000. And then we would indicate that that has capital gains applicable to any sale. So if they want to sell in a future year, let's say at age 90 or 85, for instance, we could model the sale. And then we would also have the rental income. So we would do rental income, maybe 24,000 a year. We could increase that at 1% if we want, set that as taxable, and then we would stop that the year prior to selling, so at age 84. So that's how we can enter in rental income. We have the ability to calculate tax considerations. And then if there was a mortgage, we could enter that with tax deductible interest. And we can do that for multiple properties, whether that's personally owned or we would follow those same steps, add the property in the real asset section for the corporation. And then on the planning page, we would be able to enter in the rental income under the other investment income section.
Perfect, thank you so much. Okay, well, it looks like we are pretty much at the end of the questions that we can show live here. Just one question coming in, is this session recording going to be available? Yes, this is being recorded, and it will be sent out to everyone. It usually just takes about an hour to two to process, and then it will be sent out if you'd like to review anything. And we will also have it uploaded to our YouTube channel within the next day or so. So if there's any other questions that we haven't answered live, I will follow up with you via email, so you will get the answers that you need. So thank you so much, everyone, for being here today. I'd encourage any of you who are not currently using Snap to sign up for a free trial. You can get in there and put in practice everything you have learned today, and let us know how you do. So I will follow up with everyone via email. Thank you so much, and enjoy the rest of your day. Bye for now.